The top 5 mistakes beginners make when they start investing in the stock market. Hey everyone, for those of you that don't know me, my name is Mattia, and in this channel I talk about everything related to stock market, investing and personal finance. I'm not a market veteran by any means. In fact, I only started investing a few weeks ago. And man, it's been such a wild ride. These past few weeks already taught me so much, and this is exactly why I decided to open this channel, to share this journey and knowledge with all of you. A few months ago, when I started getting interested into investing and the stock market, I was watching YouTube videos, reading articles, book summaries, and I thought I had a pretty good idea of what to do and how to invest in the stock market. This was before I even put my first pound in the market. And when I did, well, I found myself making exactly those mistakes that I wanted so badly to avoid. But at the same time, having that knowledge and awareness allowed me to quickly realize what I was doing wrong and correct it. And this is exactly the goal of this video, so that even if you're going to make those same mistakes that I did, you can recognize and correct them, so that you can become a better and more successful investor. Just before we dive into the video, keep in mind that I'm not a financial advisor, so everything I say is just for educational and entertainment purposes only, so keep that in mind and take it as such. The first mistake that most new investors make is not having a clear goal, and this kind of has two aspects to it. First of all, you need to know exactly why you are investing in the stock market. Do you just have some spare change laying around and you want to see if you can grow it? Do you want to save for buying a car or for down payment on a house? Or even, do you want to grow a portfolio that can help supplement your pension plan once you retire? These are all great questions, and answering them will help you decide which kind of investment to make and which kind of companies to buy. For example, if your goal is to supplement your retirement plan, your best bet is probably to invest in some blue chip companies which are very big and pay very steady dividend, so that you can enjoy the magic of compound interest and grow your money with time. If instead you just have some money laying around that you don't really need, you can decide to go for a higher risk, higher reward kind of investments. For example, in companies that work in newer industry or high growth markets, where you have the risk of them going bankrupt and losing a big chunk, if not all of your money, but at the same time they offer the prospect of potentially doubling or tripling your money in a matter of a few months or years. And the second aspect is having a very clear goal every time you invest in an individual company. For example, you might think that right now oil companies are a little bit undervalued, and over the next 1 month, for example, they will grow around 10 or 15%, but you don't really trust them in the long term. So you might decide to still invest in them because you want to see if they're actually gonna grow. But if that's what your goal is at the same time, once you see about 10%, let's say, increase in their price, you're probably better off selling them, even if you risk losing out on some gains, just because as quickly as they grow 10%, they can also lose 10% of their value or even more, and then you would find yourself holding companies that you don't really believe in, that you don't think have long-term positive outlooks, and that in the long term will very likely lose you money. The second mistake new investors make is not smashing the like button and subscribing to the channel. This one in particular is one that you really want to avoid. So make sure to do that right now, make the like button turn blue and subscribe to the channel. The next one is trading with emotions, and this is something that even very experienced and seasoned investors often fall for. What will happen very often is that you see a company very quickly growing in price, and you see how much gain you could have made and how much money you could have earned if only you bought their shares right before they started peaking. And so you get what's called FOMO, so fear of missing out. You are afraid of missing out on all those potential gains, and you decide to buy shares and get into that company just because of this reason. And the truth is that most of the times when you do this, you will actually end up buying near the very top, and as quickly as the share price went up, it can very well go down, and you will just lose money doing this. I'm not saying do not buy companies that are growing or that are at all-time highs. What I'm saying is don't do that just because you're afraid of missing out on some potential gains. Or what happens just as frequently is that investors see their value of their shares going down, they panic and decide to sell them. And yes, I understand, it's very painful to see all that red, the graph going down, all the losses you're making on paper. But the truth is that if you decide to invest in that company because you really believe in them, in the market they operate in, their financials, their basic, the technology that they offer. A short-term decline in price will not be anything scary for you, and actually it offers a great opportunity to buy even more shares for a lower price. No matter the company, if you look at all the most successful companies of today, like Amazon, Google, Tesla, you will see that they are their up and downs. For example, you might have bought Tesla back 1 year ago when it was around $200 or $300 a share, and for a few months you would have held it even if it went down to $200, $150, $180. But at the same time, if you had that belief in the company, that confidence in the sector, and you always held it without selling and even buying more shares when the price went down, at the moment each single share would be worth around $1,400 or $1,500 depending on the day, because the price is so volatile right now. And you would have made like 5, 6, 7 times your money. So you see how trading with emotions can actually be one of your worst enemies when you invest in the market, and can cause you to lose lots of money. And at the same time, on the flip side, having a very clear goal when you buy a company can actually set you up for success and to capture all those big swings and increases in price. The third mistake is getting too distracted and following the noise. And what I mean by this is the fact that no matter the company, there's gonna be tons of YouTube videos, articles and analyst predictions on it out there on the internet. There will be people that tell you to sell it, people that tell you to buy it, people speculating on whether the stock price will go up or down. And the truth is, what you need to do is just completely ignore all of this. And sure, some of those might cause some short-term fluctuations in the stock price, but if you believe in the company and on the long-term outlooks, that's not really gonna bother you. I want to give you a first-hand example of this. A few weeks back, I decided to invest in NIO. NIO is a Chinese company and they develop electric vehicles, similar to Tesla. The reason I decided to invest in NIO is because I think they have a very good long-term prospects, very high growth possibilities, and at the same time a very low risk. The Chinese government has helped them with loans multiple times already, and they have a very strong incentive to promote a Chinese electric vehicles company and not allow them to fail, basically. And then a couple weeks ago, JP Morgan put out an article saying that they were downgrading NIO from a hold to a sell and putting a price target on it of $7. Around that time, NIO was trading at around $13, and in a matter of a couple days, the share price went down from $13 to around $10.5 or $11. That's around a 20% decline, and the stock price chart didn't look pretty. I was looking at so much red on my Trading212 account. And what I did is I ignored it. That didn't change in any way the confidence that I have in the company and what I believe the long-term outlooks are. And actually, I was thankful to JP Morgan because they allowed me to buy even more shares at an even lower price. And right now, NIO is once again trading around $13.5, and they still believe that in 1, 2, 3, 5 years, their share price will absolutely skyrocket and will allow me to make lots of money. Mistake number 4 is only deciding which company to invest in by looking at their stock chart. And unless you are a day trader and you really know what you're doing, the stock chart doesn't really offer many valuable information to you. And you should really instead focus on their fundamentals, the balance sheet, cash flow statement, income statement, and their history in regards to those. The reason for this is the fact that the past performance of a company and the past performance of the share price does not give you any indication whatsoever of future performance. Most of the companies that are traded today will have graphs that either go up in a pretty consistent way or at the very worst sideways. And you want to know what the reason for that is that when a company price keeps going down and down and down, it means they are losing more and more money, and they will get to the point where they have to file for bankruptcy and basically fail. That's when they get delisted, their stock price goes to zero, and you lose all of your money. But of course, since they are delisted, you cannot find them anymore on your trading app or trading platform, and therefore you get a false sense of security because you don't see the bad examples and you only look at successful companies. And sure, I'm not gonna lie, the stock price can give you some little bit of information, and in particular give you an idea of, first of all, how other people and other investors value the company, and secondly, you can see if there's been any recent jump or decrease in price that has not been justified by any change in their fundamentals or any news coming out, but at the same time that's very limited information, and that should not be the only reason you decide to invest in a company. And the last one, mistake number 5, and I know this is gonna be the most controversial one on the list, is diversifying too much. Even Warren Buffett, arguably the most successful investor who ever lived, says that diversification is a protection against ignorance, and you shouldn't need it if you know what you're doing. And I completely 100% agree with him, and I'm going to explain to you why. There are two main reasons for this. The first one is that there are simply not enough great businesses out there in the market. If you wanted to invest 1 year ago, you would only have found one Tesla in the market. Maybe there were 2, 3, 4, 5 companies that offered the same growth potential, risk profile, had the same crazy management as Tesla. But there simply are not enough great businesses out there to spread yourself that thin and invest in like 20, 30, 50, 100 companies. And it's simply not worth it. Sure, your risk of losing money might decrease a little bit, but your potential gains take a huge hit. And the second reason why you shouldn't diversify too much is the fact that you simply do not have the time to research that many companies in details. If you're looking into a business and you think they're like okay but not great, just leave it aside and go on to the next one. When I decide to invest in a company, I need to understand their business model, how they make money, get to know their management team, and then understand how they plan on expanding and growing the business. I also look at their balance sheet, cash flow statement, income statement, how they change with time, how news affected them, what their stock price looks like, what are their sector growth prospects in the future, and so many more different aspects. It takes dozens, if not hundreds of hours to thoroughly research a company. So when I'm done, if I really believe in the business, in the management, in their growth prospects, and I think they have a reasonable risk profile associated with it, I should also feel more comfortable putting more of my investment into them, because I spent so much time researching them and everything that I found tells me that they are a good investment. So if you're completely new, diversifying might still be good for you because it allows you to reduce your risk, while at the same time learning a little bit more and learning how to do your research. And even if you make a couple mistakes on 1 or 2 companies, you're not gonna be punished as hard and lose as much money because you invested less in them. But the more and more you learn, grow, and understand how to research and decide which company to invest in, you should reduce the company you decide to put your money in to the very good one, the ones that you're very confident in, and at the same time put more money into each one of them. And that's it. These are the 5 biggest mistakes that beginners make when they start investing in the stock market. In my opinion, of course. I'm very interested to know what you think about them, if you agree or disagree, and if you made any of them yourself. I for sure did. So feel free to let me know in the comment section down below and share your thoughts. I'd love to discuss and talk more about this with all of you. I also hope you found it helpful and informative, and if you did, once again, make sure to smash the like button down below. And with this being said, I'll see all of you in the next video.